or each plant. This is one of the primary reasons for why nuclear power polls highest in communities that already host nuclear facilities. And it is worth mentioning that the nation's support for nuclear power has climbed to 62% in Gallup's annual survey, the highest mark since it began asking the question in 1994. While the legislative and regulatory focus in Washington continues to be on greenhouse gases, it's important to acknowledge that nuclear power not only emits no greenhouse gases, it emits no hazardous air emissions at all. Other countries are well aware of the economic and environmental benefits of nuclear power. 55 reactors today are currently under construction around the world in 13 countries, with another 140 planned in the very near future. The International Atomic Energy Agency estimates that there could be up to 25 nations with operating reactors by 2030 that do not currently have a nuclear program. Yet, this country hasn't licensed the operation of a new reactor in over 30 years. Many opponents of nuclear power seize on announcements of other countries making investments in renewable power generation, but usually fail to note that these investments are but a fraction of what the world community is making in new nuclear generation. So what is it that these countries know the United States seems to be missing? These countries realize that nuclear power must play an increasing role in meeting projected increases in demand for power, in reducing greenhouse gas and hazardous air emissions, and doing so in an efficient, economical, and reliable manner. While the governments of many of these countries directly finance the construction of new reactors, we rely predominantly on investor-owned utilities, as well as municipal and cooperative ventures to do it. However, without a federal loan guarantee program to help secure financing for the first bunch of these new reactors, we will likely not see enough nuclear generation to even make up for the lost generation of retiring reactors over the next 30 years. It has become fashionable to argue that the United States is missing the proverbial boat on the clean energy revolution around the world. While it is almost never the speaker's intention to include nuclear power in this mix, they are correct that every year that goes by while we debate whether to support new nuclear builds, we are missing out on the largest component of the global clean energy market. Thank you.
I thank the gentleman and each member of the panel. It's much appreciated your presence here. Having had the chance to review your testimony, this, I have to say it's greatly valued, and I think it will be very helpful for members of the subcommittee to read and review carefully the testimony of each and every individual here. I'd like to go to the members of the panel now and ask, what's your opinion of a credit subsidy fee that's secret, not disclosed to the taxpayers? Mr. Cooper.
Well, it's quite remarkable that this administration, which had prided itself on transparency and open government, would come forward and suggest that something as important as the liability to which taxpayers are being exposed will be a trade secret between the Department of Energy and those utilities. As Mr. Bradford pointed out, in theory, the Public Service Commission might get a chance to look at that or might not. That will influence the rates people pay, but it would seem to be a desire to hide the truth, which is that the taxpayer is being hosed in these transactions.
Mr. Sokolsky.
I don't know. I'd ask for my money back. I wouldn't make the loan. You've got to know that. You are the executors of this effort as it is. I mean, we're not talking about doing this or not doing this. We're asking, do we do more of this? We're in the business now of doing it. I'd say you need to really get the facts and figures on what we're doing before you pile on more.
Mr. Caperton.
There are three things that are secret now. The model that's used to calculate the credit subsidy fee, the inputs to it for each loan guarantee, and the results of the model, what that fee actually is. I can certainly see that the first of those, the model, should be made public, and the fee should likely be made public. There would certainly be trade secrets involved in what goes into the model, so I could see elements of that being kept proprietary.
You know, I studied your testimony, and you actually did a kind of a reverse engineering of the Office of Budget and Management model by saying that it's essentially the present-day value of the expected payouts that the government will have to make on a loan if the utility should default.
That's correct.
Okay. Mr. Scott.
It's actually unnecessary for them not to disclose it because the applicant will end up disclosing it in SEC filings anyway. So it's going to become public, assuming that it's a SEC applicant. And if you're doing that, you might as well do it for all the projects.
So it's an interesting point you raise, and that is, if OMB says it's proprietary, does the SEC give the applicant a waiver on that?
I doubt that they would, and I don't think any of the companies would.
It's an interesting question.
Yeah.
Mr. Guth.
I think it's important to note that Congress does have access to this. The appropriators who create the authorization for this have asked for annual reports, and they're fully informed as to what this is. And I'm sure that, well, I don't want to speak on behalf of the department, but when I was there, we never would not disclose said information to the Congress. Secondly, I think the model itself should definitely be disclosed. I think that created much consternation over the last 2 years that nobody in any industry could figure out what OMB was doing. And frankly, those of us who worked in other agencies couldn't figure out what OMB was doing, and Congress certainly couldn't figure out what OMB was doing.
Well, let me ask you, bondholders and shareholders, is there a legitimate reason for keeping the credit subsidy cost from them?
The ultimate cost itself?
The credit subsidy cost. I mean, should bondholders and shareholders have a right to that
This
information?
is one of those, when did you stop beating your wife questions? Because on its face, absolutely not. Everything should be transparent. But the question is what does a specific number, in addition to other information, actually lead you to? I mean, this issue has come up more in the non-nuclear loan guarantees than it has in the nuclear loan guarantees. Because as other competing power generation sponsors or applicants have gone through this process, they don't want to necessarily have their information disclosed to other competitors.
Surely you recognize that this Congress has had brought before it in the last year many issues where shareholders were not adequately informed of the transactions that were being undertaken by the management of their companies. That's why I raised the issue.
And as I said, I mean, on its face, the number, everything should be transparent. It's in what context and what other information is disclosed. And certainly in this case, Congress is fully informed as to what the number, the process is, certainly as well as anyone.
Can hope so. Now, I mean, it reminds me of an old story about how we have a system of checks and balances, or the administration writes the checks and Congress doesn't know what the balance is. Now, for the panel, does the Department of Energy's track record justify public confidence in its ability to fairly and accurately price the value of the credit subsidy of loan guarantees to the nuclear industry in order to protect taxpayers from a large bailout of the nuclear power industry? And is the Department of Energy more likely to overestimate the cost of the credit subsidy, or are they likely to underestimate it? Mr. Cooper.
I don't think the Department of Energy has much of a record. I've been around long enough to remember the Synfuels program, and we were adamantly opposed to that. The notion that the Department of Energy is substituting its judgment for the judgment of Wall Street, maybe hiring some consultants. There are a lot of them out of work these days to help them work through some of these numbers. From my point of view, the program was a small program. They should have left bad enough alone. The administration has thrown a lot more money into the pot. We hear rumors of unlimited loan guarantees. In the end, this could make the Synfuels program look like a walk in the park.
Mr. Sokolsky, do you want to respond to that?
Synfuels, the breeder reactor, the mandates for ethanol where they miscalculated suggest someone needs to come up with the alternative record where they've done well. I think the other thing is, my understanding is the number of analysts working due diligence within DOE is a pale reflection of the numbers you'd find in a competent, reputable large bank. Now, I don't think a reputable large bank has been doing so well. And so I just wonder, final point, there could be a conflict of interest. The DOE was intimately involved in not just promoting, but helping to pay for the design of the reactors we're talking about seeing built in the case of Westinghouse. So I don't think that's the place you want to have your analysis done.
Thank you. I'd like to just get brief answers from the rest of the panelists, and then we're going to go to Mr. Jordan. Go ahead.
Sure. This is a unique program, and so I don't know how much previous DOE experience is going to be effective in judging their ability on this one. But the Congressional Budget Office has clearly stated that they think DOE will underestimate the cost of these loans by at least 1% for a variety of reasons, including that utilities who are borrowing this money, who are applying for the guarantees, if they think it's a bad deal, they won't take the guarantee. So only borrowers who think it's a good deal will take the guarantee.
Thank you. Mr. Scott.
So in this particular program today, we don't have much of a record, and we won't for a number of years with respect to any closing on a nuclear, because the loan guarantee actually won't close for 2 to 3 years before they fulfill the conditions precedent. And it's actually at that point that OMB calculates the credit subsidy. Historically, if you go back to other programs that are targeted towards corporate America, and the ATSB after the airline program after 9/11, OMB had estimated, and CBO had estimated, between a 30 and 35% credit subsidy rate. We ended up making 6 loan guarantees. At the end of the program, we netted about $300 million in fees after three technical defaults and one $20 million compromise. So that brings the credit subsidy down to negative 18%. So the track record under the Federal Credit Reform Act is actually fairly good at predicting the costs. I'm actually less concerned about OMB's ability to accurately measure the costs than some of the other participants.
I agree that since most of the examples that have been cited on this panel have been prior to the passage of FCRA, which was 1990, which has completely reshaped the loan guarantee process, agency or government-wide, whether it's USDA, whether it's Ex-Im Bank, whether it's DOE.
Recognize Mr. Jordan.
Thank you, Mr. Chairman. I'm just interested in the panel, particularly our first 3. I think it's kind of interesting. The Chamber supports the program, but the academic and the 2 think tanks are opposed to it. So not something you always see. And the Bush administration individual, I believe, is somewhat supportive based on what I gathered. And I understand various reasons and things associated with all that. But for our first 3 in particular, who talked about how bad this program was and shouldn't be in it, and market forces should be at work, et cetera, where are you at on taxpayer assistance, subsidies, loan guarantees, whatever, for other energy, other areas of energy, other resources? I think Mr. Sokolsky's statement was, you said that loan misdirect resources. So do you support subsidies for ethanol, biodiesel, solar panel? And we'll start with Mr. Cooper, and we'll just go down the whole panel.
If I could get a subsidy-free energy environment, I would take it. I would prefer to live there than in the mess I've got here. But since I can't, and the interesting thing in the previous panel, people missed the biggest subsidy of all, which is the Price-Anderson limit on liability to the industry. And so you have you have the federal commitment to waste, which was pointed out as a subsidy to the industry. And so you've got embedded subsidies all over the place. So I would rather talk about the principles by which subsidies should be awarded to various sectors. And the principles ought to apply to all the technologies. So 1, the public policy should target an identifiable market failure. If you can't show me the market failure, then the government shouldn't be in the policy business. Let the market do it. 2, we should have a level playing field. And we haven't had one in the energy sector for an awfully long time. 3, the policy outcomes should be very clear. And as a consumer advocate, I like least cost. I like biggest bang for the buck. Diversity also is a good proposition. You've heard people speak to that. Fourth, there has to be fiscal responsibility. And as I see the loan guarantee programming being rolled out, it would appear to be that the sky's the limit, especially when I can't have secrets about the cost. And fifth, there has to be administrative accountability. Given that I have to live in an environment that's riddled with subsidies, I have to start making sure that they work for the public interest.
My grandmother had an expression for answering questions like that. She would say, "Enough already. We're up to our gills in this. This country's becoming a little broke. I think we need to stop. We need to stop this." We made a lot of mistakes, in my opinion, in bailing out companies we knew that were failing. They should have maybe used a little money to let them fail gracefully, but not save them. Two more comments.
No disagreement from the chairman and the ranking member on that.
Say again?
No disagreement from the chairman and the
Well, there
ranking member on
oughtn't
that.
to be amongst Americans on that. We're in trouble, sir.
I agree.
Now, it seems to me, two other comments that might add some value. First, when I get principled environmentalists in a room who are economists, they say things like you heard, but even further. They join with fiscal conservatives in saying subsidies, even for wind, solar, etc., will hurt their cause. And the reason why is when you put the subsidies out there, the biggest pigs, coal, nuclear, are going to not only eat the most, but they're going to set the rules in that playpen for a long time. You need to experiment. So that's the last thing you want. Last comment. The only role for government, and it's why we have the Department of Energy, and it's a problem because it's not a great actor in my opinion, is that state regulations don't allow people to capture the rents associated with fuel efficiency in your mind. And that's the reason the government does it. We don't do a great job of it. I think regulatory reform would go a long, long way in solving that problem. I suppose I should close on one point. I served on a congressional commission that you put me on to prevent WMD proliferation and terrorism. And one of the things we unanimously, bipartisan supported was we should discourage the use of financial incentives to promote nuclear power. And the reason why isn't because of problems here, but because you lose your moral authority to talk to countries like Iran, who, after all, point to us and say, ubi es mea, we'll do the same. You want to subsidize, so do we. Who cares if it's economic? I think we should care.
Well, to clarify, we're not opposed to these loan guarantees. We're supportive of a fully functioning Title 17 loan guarantee program. Now, I think there are some characteristics that we should look at to judge whether or not a loan guarantee is effective. First, does it address a market failure? In that case, we can look further. Then we want to look at exploring technologies and promoting technologies that provide clean, cost-efficient, and safe energy to American consumers. There are potentially some instances where nuclear programs meet those criteria. There are certainly instances where wind and solar meet those criteria, and other technologies meet those criteria.
Title 17 has 10 very broad categories of technologies are eligible. If you implement the program under 1702B2, which is the borrower pay provision, it's actually technology neutral in the sense that you don't have to allocate scarce federal dollars to any particular technology, and it's more a function of how long does it take the technology to get into general use, which is then the...
Well, but we have other subsidies I mean, we have the tax credit available for the ethanol industry. We have other ways that taxpayers finance other forms of energy.
Sure, sure.
And you are supportive of, you agree with that or opposed to that?
About Title
All right,
17.
We had the privilege of testifying, my boss, in front of your colleagues, the Ways and Means Committee, last week on fiscal policy as to I think it was the green economy expansion. And while we certainly support fiscal policy as one of the tools, I mean, we do have to take into account where we are in a entire economic perspective, which is right now we are running record deficits and project to do so for some time. And there are things, much like concessionary financing, like loan guarantees, as well as perhaps the seated proposal that both the House and the Senate have looked at, in addition to, as was mentioned in the previous panel, regulatory reform that can be done without any taxpayer dollars. And I think that is, especially in this resource-constrained environment, where Congress should be looking.
Good. Thank you. Thank you.
We're just going to go for a few more questions.
Yeah, go fire away, brother.
Okay. Thank you, Mr. Jordan, for participating. For Mr. Caperton and Mr. Scott, hypothetical, if there's a default in one of the loan guarantees relating to the construction of a nuclear power plant, such as, may be caused by weak natural gas prices, the market falls apart. Could that indicate a greater likelihood that a default will occur in one of or more of the others? In other words, possible defaults may not be independent results. Instead, they may be interdependent on the overall, on energy markets.
I'm not quite sure if I follow
Okay, we've established in the last panel that that the Energy Information Agency says there's going to be weak natural gas prices for decades, relatively weak. That is, do fluctuations in the larger energy environment create consequences for these investments in nuclear power plants that that actually establish a relationship between the investment in those plants and a larger energy markets? Is this something that people should take heed of?
I think that I want to make sure I answer your question. The two nuclear reactors aren't necessarily connected, and a default in one shouldn't necessarily affect a default risk in another one. The underlying economics of energy markets, in this case, low natural gas prices, could certainly affect all sorts of nuclear reactors. So I would think that what causes a default in one could very well be indicative of what might cause a default in another, but the default themselves likely don't cause each other.
Mr. Kucinich,
Yes.
let me try that, because I actually looked at that in the case of Florida at the Public Utility Commission. And if you looked at the moment when they made the decision to issue a certificate of need, there were a key series of assumptions the utility made to justify the economics of the plant. In the ensuing 2 years, 3 of the most fundamental assumptions changed dramatically. The cost of the plant went up, the cost of natural gas went down, and the phenomenal load growth projection evaporated. The utility now sitting there, having committed to the plant, spending hundreds of millions of dollars, now is faced with a whole new set of economic conditions. And in order to justify continuing with this project, they begin to change their 10-year plan. They start pulling out natural gas plants, because they don't need them anymore, to make room for the nuclear plant, whose economics has been undermined. They launch a campaign to oppose energy efficiency and reduce it in the integrated resource plan to make room for the nuclear reactor. So in a 2-year period, the economics changes dramatically. And of course, some people will say, well, we're doing this for 20 or 30 years. But in a time of uncertainty, The one thing you want in your investment portfolio is flexibility.
Well, but in terms of energy flexibility, I just want, we have to, do we also, of necessity, have to factor in the time it takes to put an energy facility online,
well,
so that it melds into the overall energy supply?
If you look at the case of Florida, the projected date when they thought they would need the reactor was 2017. When you bring in the change in demand, if you actually look at climate legislation, that same peak would not have occurred for 20 years. That means that what you want to do is wait before you commit to this massive project. A prudent decision is says, wait, I can wait for 5 years. I can wait for 10 years. And as a prudent investor, you want things in your portfolio that give you that opportunity. And so the inherent nature of these projects with their long lead time raises their cost of capital, raises their risk, and has exactly the effect, and natural gas has exactly the effect that you suggest. So
well, I'm looking at independent variables here. For example, new technologies come in. I mean, it was the last year the wind, American Wind Energy Association has said that they've added about 10,000 megawatts of new wind generating capacity in a year. Some say, well, that's the equivalent of 10 nuclear power plants. That's an independent variable that changes markets, okay? In the meantime, if you can move a new technology in, then you have other technologies that won't move as quickly in because of the capital-intensive nature and the time that it takes to build a plant, and let alone repair a plant that might have a problem. So I just wondered, in terms of the totality of energy markets and the variables that you have to consider, does that start to drive the risk factors of some technologies as opposed to others? In this case, we're talking nuclear. Anybody else want to try?
Mr. Chairman, yeah, I think,
Mr. Good?
yes, it certainly does, which is why you don't see any utilities right now rushing out to build a reactor. It is still very uncertain. And I think it cannot be overstated that at the end of the day, the risk that is placed upon these individual companies is so significant that they are not going to rush into it, as has effectively been implied, willy-nilly, unless they know the demand is going to be there. Obviously, the economic situation over the last 2 years has changed the entire energy landscape for the near term, but we still have significant projections in electricity demand in this country and certainly around the world. And just to make one point about your the EIA natural gas projections, I think it's important to understand what EIA does and what EIA doesn't do. EIA does not model based on any assumptions that are not currently in law, which is to say they're limited by rule, by congressional rule, as to what they can assume. Therefore, they're going to assume that every single tax credit that exists is going to grandfather out because the law says so, that every single subsidy is going to grandfather out, which is to say that I think you look at where Wall Street money is going right now and where investment money, it's going into natural gas. It's not going not going into natural gas, and it's going in there because they expect prices to increase.
You know, you raise a question about you know, why Wall Street's not rushing in right now. And it gets into this a potential of the moral hazard discussion that we had on bailouts. Now, Mr. Jordan and I both voted against the bailout. And if Wall Street looks at the risk factors here and just says, no, you know, we don't really want to go there right now. I mean, I will tell you, in the Cleveland area, we had a company by the name of the Cleveland Electric Illuminating Company, which was a top-rated company, blue chip stock. They bought into nuclear power, and it wasn't too long, you know, within a decade or so, they started to run into serious financial trouble. Wall Street isn't taking the risk. So what we're doing, the risk factors that are laid out here today are essentially being taken up by the taxpayers. Now, whether you're for nuclear power or not, we're just talking economics here. They're being taken by the taxpayers in in a constantly changing energy environment. New technologies being brought on, old ones starting to, either get renewed, energy drilling policy or the energy bill that passed. That's why this issue of transparency, the issue of trying to figure out what the government's exposure might be, is not a small matter in a climate where everyone wants to know how much something's going to cost. Can we make some reasonable projections? What's our exposure here? Anybody else want to comment on that before I move on to something?
Yeah, Mr. Chairman,
Mr. Scott.
All of the factors that you raised, whether it's natural gas prices or other competing technologies, end up being evaluated both by the project sponsors, by DOE, by OMB, by the rating agencies. And, practically speaking, the agency may have views on assumptions about electricity prices or gas prices that are different than a project sponsors, and ultimately gets reflected in the underwriting of the project. Now, they may or may not be right. The companies may not be right. The government may not be right. But you fast forward when, in particular around nuclear, if you think about when a loan guarantee would actually close, because they have to meet the conditions precedent, you remain 2 to 3 years away before you're going to see an actual closing. And it's the assumptions at that closing time that are going to be relevant to the evaluation of the business plan, both by the rating agency as well as by OMB on the credit subsidy side. So at the end of the day, you end up with the best information that you have when you need to make that decision and when you're actually exposing the taxpayer on the federal loan guarantees.
It's interesting because, the familiar anchor points which we have to try to come to a level of analysis that would say, well, this is our best estimate. We've started to see in the last couple of years some changes in the status. You mentioned credit rating agencies, okay? You look at the credit default swaps and some of the information that credit rating agencies really had a responsibility to disclose, but they were in a conflict. We see the latest Abacus case involving Goldman Sachs. Credit rating agencies again come into play with raising questions about the information they're providing to the public. We see that shareholders not being given information they were entitled to, they didn't get it, lack of transparency. We see even in this environment Congress having trouble fighting for a bill that would bring about financial reform and bring a new measure of transparency. So in that kind of an environment, you have to forgive this chairman for being a little bit cautious about how much more of an exposure in a highly risk-filled environment we want to provide for the taxpayers. That's why this is a very important discussion, because I looked at your resume, Mr. Scott. You have been as much as anybody, over all of these issues related to credit availability, credit guarantees. I happen to believe that there are some cases in which that it's an appropriate role. I think that R&D in particular is a great place that we could incentivize all kinds of possibilities for the government to start things happening. But when we instead of buying a few implements, we buy the farm. It starts to become a little bit more problematic. And I want to thank each of you for being here today. We've had excuse me, Mr. Cummings. Thanks for joining us. Do you have any questions?
Mr. Chairman, I thank you for calling the hearing. And I have my questions for the record.
I appreciate that. The members of the committee have 5 legislative days in which to submit questions, and I would ask the members of the panel and the previous panel to please be available to respond in writing to any questions that members may have. Again, very impressive panel. You've really given all of us in Congress, a lot to think about here. We'll make sure that your testimony gets widely distributed. This is the Domestic Policy Subcommittee of Government Oversight and Reform. This committee has been about nuclear loan guarantees. We'll probably have one or two more hearings on this. This committee stands adjourned.